Every year, $1 trillion is quietly extracted from American workers and transferred to bondholders. $1 trillion. Not through taxation, which at least requires congressional votes and public debate. Not through theft, which would be prosecuted. Through interest payments on government debt. $1 trillion per year flowing from teachers, nurses, truck drivers, and small business owners to pension funds, insurance companies, and asset managers. From labor to capital, from the many to the few. Forever. This isn't accidental. This isn't a crisis that emerged from policy mistakes or economic mismanagement. This is stage 7 of a system designed 331 years ago to do exactly this. Extract wealth perpetually, make debt permanent, ensure interest flows upward without end. And stage 7 is the terminal stage, the point where the mathematics become irreversible, where the extraction accelerates beyond sustainability, where the system that created trillions in profit for bondholders finally consumes itself. In 2025, the United States federal government owes $36 trillion. Interest payments on that debt will exceed $1 trillion this year. That's more than defense spending, more than education, infrastructure, and scientific research combined. $1 trillion paid to bondholders simply for the privilege of having borrowed money in the past. Who are these bondholders? Approximately 40% is foreign governments. China, Japan, European nations holding dollar reserves. Another 40% is domestic institutions, pension funds, mutual funds, insurance companies, banks, and increasingly, the Federal Reserve itself, which has purchased trillions in bonds by creating money from nothing. But look deeper at the institutional holders. 3 companies manage most of the assets: BlackRock, Vanguard, and State Street. Combined, they control over $20 trillion. They buy government bonds with other people's money, your retirement account, your insurance premiums, your pension contributions, and they collect the interest. $1 trillion per year, flowing from taxpayers to bondholders. It's the largest wealth transfer in human history, continuous, structural, and invisible to most people. This isn't called theft. It's called debt service. But the mechanism is identical. Workers produce value. The government taxes that value. And instead of funding services, $1 trillion per year services debt that will never be repaid. Because the debt isn't meant to be repaid. It's meant to be permanent. That was the design from the beginning. This system wasn't born yesterday. It's 3 centuries old, built by 4 architects across 4 critical moments. Each architect solved a problem for the wealthy and powerful. Each solution built on the previous one. And together, they created a machine that extracts wealth from the productive economy and channels it upward to creditors, not through conspiracy, through structure, through law, through institutions that persist long after their creators are dead. Stage 1, the initial trap, permanent national debt. Interest payments forever. This is where it begins. 1694. England is at war with France. King William III needs money desperately. The treasury is empty. Traditional lenders won't lend because England has defaulted before. A Scottish merchant named William Paterson approaches the king with a proposal. He'll organize wealthy merchants to lend the government £1.2 million, about $300 million in today's money. But here's the innovation. The loan will never be repaid. Instead, the government will pay interest forever, 8% annually, forever. Why would merchants accept this? Because the interest payment is guaranteed by Parliament, backed by the government's power to tax citizens. As long as England can tax, the interest flows, and the bank notes the lenders receive can be traded. They're as good as money, better than money, because they pay interest. Parliament approves in 1694. The Bank of England is chartered. The merchants provide their gold. The government gets war funding. And for the first time in history, national debt becomes permanent, not a problem to solve, a feature of the system. This is stage 1. Debt is no longer temporary, borrowed in crisis, repaid in peacetime. Debt is permanent. The government borrows, pays interest forever, and never repays the principal. The lenders effectively purchase an annuity from the government. As long as the state can tax, the money flows. Within 50 years, every major European power copied the model. France, the Netherlands, Spain. By 1790, the newly independent United States adopted it. Alexander Hamilton explicitly modeled America's financial system on the Bank of England. Permanent debt, interest paid from taxes, bonds traded as currency. The trap was set, and every government since has walked into it willingly. Stage 2. Debt becomes money. The government's IOU becomes currency itself. Here's where Paterson's genius reveals itself. The Bank of England was given the right to issue banknotes backed by government debt. They could print paper money up to the value of the loan. This created money out of debt. The government's promise to pay became currency. The more the government borrowed, the more money could be created. This is alchemy, transforming debt, a liability, into money, an asset. And it works because everyone agrees to treat the IOU as valuable. The Bank of England note says, "I promise to pay the bearer." But pay with what? With another note. The promise is circular. The value is faith. Faith that the government will tax citizens to pay interest. Faith that the system continues. By 1800, most money in circulation wasn't gold or silver. It was paper backed by government debt. Money had become debt, and debt had become money. They were the same thing. This is stage 2. The distinction between currency and government obligation disappears. Every dollar, every pound, every euro in existence today is created the same way as debt. When the government borrows, money is created. When debt is repaid, money is destroyed. The money supply is debt. This has profound implications. It means the government can never fully repay the debt. If it did, the money supply would collapse. Deflation, depression, economic catastrophe. So the debt must be permanent, must grow, must expand continuously, not because of irresponsibility, because the money system requires it. Stage 3. Debt goes global. The trap becomes inescapable through interconnection. Early 1800s. European governments had embraced permanent debt, but there was no organized market. Each loan was negotiated individually. Interest rates varied wildly. Only the wealthiest merchants could participate. Nathan Rothschild changed that. The Rothschild family established banking houses in 5 European cities by 1800. London, Paris, Frankfurt, Vienna, Naples. This network allowed them to move money across borders faster than anyone. And Nathan Rothschild in London saw the opportunity. During the Napoleonic Wars, he didn't just lend to governments. He created a market. Instead of lending directly, Rothschild bought government bonds at a discount and resold them to investors at a markup. He created liquidity, a secondary market where bonds could be traded. Government needed money immediately. Rothschild provided it. Then he sold the bonds to pension funds, insurance companies, wealthy individuals across Europe. The government got funding fast. Rothschild collected the spread, and investors got a tradable asset. But here's the crucial innovation. Rothschild made sovereign debt tradable across borders. A British bond might be owned by a French investor who sold it to a German bank, who used it as collateral for a loan to an Austrian aristocrat. The web of ownership became so complex that defaulting wasn't just refusing one creditor. It was collapsing an entire international financial network. This is stage 3. Debt becomes interconnected globally. Default anywhere threatens systemic collapse everywhere. Governments become trapped. They must keep paying, must keep borrowing, because the alternative is catastrophic. Not just for them, for the entire system. Rothschild didn't just finance governments. He made governments dependent on a system where default became impossible. By 1850, European sovereign debt was the foundation of international finance. The system Paterson created in 1694 had become global, inescapable, and extraordinarily profitable for those who understood it. Stage 4. The central bank trap. Unlimited demand for government debt. 1900. America is industrializing rapidly, but its financial system is primitive. Banks operate independently. No central coordination. Financial panics are frequent. In 1907, a panic nearly destroys the economy. J.P. Morgan personally organizes a bailout. He forces New York banks to pledge their own money to stabilize failing institutions. It works, but Morgan is 70 years old. He can't do this again. So Morgan and his associates, the most powerful bankers in America, design a permanent solution. They need a central bank. But Americans hate central banks. The first and second banks of the United States were shut down by populist opposition, so they disguise it. In 1910, Morgan's representatives hold a secret meeting on Jekyll Island, Georgia. For 9 days, they design what will become the Federal Reserve System. The brilliance is in the structure. It won't be called a central bank. It'll be called a Federal Reserve System. It won't be one institution. It'll be 12 regional banks. It won't be controlled by Wall Street. It'll be overseen by a board appointed by the president. It looks decentralized, democratic, public, but the structure ensures banker control. The regional Federal Reserve banks are privately owned by member banks. Those banks elect the boards, and the most important power, creating money and buying government bonds, goes to the Federal Reserve Bank of New York, controlled by the largest Wall Street banks, Morgan's banks. The Federal Reserve Act passes Congress in December 1913. Most representatives don't understand what they're voting for. And immediately, the debt trap expands exponentially. Now, the government doesn't just borrow from banks. It borrows from the Federal Reserve, which can create money to buy bonds. Unlimited demand for government debt. This is stage 4. Before the Federal Reserve, there was a limit to government borrowing. Banks only had so much money to lend, but the Federal Reserve can create money by purchasing government bonds. The government issues debt. The Fed buys it with newly created money. The government spends, and the debt goes on the Fed's balance sheet, backed by nothing except the promise that taxpayers will service it forever. This mechanism enables infinite debt. The Federal Reserve ensures there's always a buyer for government bonds, always demand. The government never has to stop borrowing. It can roll over debt forever because the Fed will always buy it, and the interest payments flow from taxpayers to bondholders eternally. Morgan died in 1913, the same year the Federal Reserve was created, but his legacy is the structure that makes current $36 trillion debt possible. Without the Fed as guaranteed buyer, the market wouldn't support it. With the Fed, there's no limit. Stage 5. Default becomes impossible. Structural adjustment makes debt inescapable globally. By the 1970s, the debt trap Paterson, Rothschild, and Morgan built was functioning globally. Every developed nation borrowed, rolled over debt, paid interest. But developing nations were different. They borrowed for infrastructure, and many couldn't keep up payments. The debt trap was reaching its limits. Then Volcker made it permanent. Volcker was Federal Reserve Chairman from 1979 to 1987. He faced a problem. Inflation was over 10%. U.S. credibility was eroding. He needed to stop inflation even if it meant recession. In 1979, Volcker raised interest rates dramatically. The federal funds rate went from 11% to 20%, the highest in American history. This crushed inflation, but it had another effect. Developing nations had borrowed billions in dollars during the 70s when rates were low. Now those loans were due and interest rates had tripled. Mexico owed $80 billion, Brazil $60 billion. They couldn't pay. The interest alone exceeded their export revenues. In August 1982, Mexico announced it couldn't make payments. Default. This should have triggered collapse. American banks had lent that money. If Mexico defaulted, Citibank, Bank of America, Chase Manhattan would take massive losses. The banking system was at risk. Volcker could have let it happen, let the banks fail, let the market clear. Instead, he orchestrated a bailout through the International Monetary Fund. The IMF would lend Mexico, Brazil, Argentina enough money to keep making interest payments to American banks. The loans were called structural adjustment loans, and they came with brutal conditions. Cut government spending, privatize state assets, open markets to foreign investment, devalue currencies, dismantle economic sovereignty in exchange for the money to keep paying interest. But here's the critical innovation. The IMF loans didn't reduce debt. They just rolled it over, made it manageable but permanent. This is stage 5. When debt becomes unpayable, don't forgive it. Restructure it. Lend enough to keep interest payments flowing. Extract political and economic concessions in exchange. The debt trap becomes a tool of control. Countries that can't pay are forced to open their economies, sell assets, submit to foreign economic policy, all for the privilege of staying in debt. This pattern has repeated for 40 years. Greece, Argentina, Sri Lanka, every time the same structure. IMF loans to keep paying interest. Austerity imposed, sovereignty surrendered, and the debt never eliminated. just restructured, made perpetual. Volcker died in 2019, but his legacy is the mechanism that ensures the debt trap is global and inescapable. Stage 6. Consolidation. Interest flows to concentrated power. By 2010, the debt system was fully mature. Governments borrowed perpetually. Central banks ensured demand. IMF prevented defaults. The machine functioned smoothly, but wealth was concentrating. 3 companies emerged as dominant: BlackRock, Vanguard, and State Street. Combined assets over $20 trillion. They buy government bonds with other people's money, pension funds, retirement accounts, insurance premiums. They collect the interest, approximately $1 trillion per year from U.S. debt alone, plus interest from Japan, Europe, everywhere. This is stage 6, the consolidation phase. The institutions that hold the debt are now so large, so powerful, that they operate beyond government control. They don't lobby governments. They are the market. When BlackRock speaks, central banks listen, because BlackRock manages more assets than most nations' GDP. The $1 trillion per year flowing to bondholders goes to these institutions. They distribute some to pension funds, some to insurance policy holders. But the management fees, the carried interest, the control, that stays concentrated. This is the largest wealth transfer in history. From workers to capital, from the productive economy to financial intermediaries. $1 trillion per year, every year, forever. Stage 7. Inevitable breakdown. The mathematics become terminal. Stage 7 is where we are now, the point where the system's internal contradictions become irreversible, where the extraction accelerates beyond sustainability, where the mathematics guarantee rupture. Every debt system that reaches stage 7 follows the same sequence. 7 steps from credibility loss to complete breakdown. Step 1. Interest payments consume all growth. U.S. GDP grows approximately 500 to 700 billion per year in real terms. Interest payments are approaching 1.2 trillion. 100% of growth goes to servicing debt. None remains for infrastructure, services, or investment. Step 2. New debt-only services, old debt. The deficit in 2024 was 1.8 trillion. Interest payments were 900 billion. Over half of all new borrowing exists owed solely to pay interest on previous borrowing. This is the mathematical definition of a Ponzi scheme. Step 3. Central bank becomes buyer of last resort. Foreign governments are reducing treasury holdings. China cut from 1.3 trillion to 775 billion. The Federal Reserve must buy to prevent yield spikes. But Fed purchases equal money printing, which causes inflation, which forces the Fed to raise rates, which increases debt service costs. The trap closes. Step 4. Inflation or default become the only options. The government cannot raise taxes 50%, cannot cut spending 70%. The debt cannot be repaid through fiscal adjustment. The only options are inflated away by printing money or default explicitly. Both destroy creditor wealth. Both trigger crisis. Step 5. Credibility breaks. When bondholders realize the government cannot repay, they demand higher yields, or they sell. Either way, interest costs spike. The government must print money to buy bonds. Currency value collapses. Hyperinflation begins not as policy choice, but as mathematical necessity. Step 6. Political rupture. When inflation destroys savings, when interest costs prevent government services, when the system visibly benefits bondholders at worker expense, political legitimacy evaporates, not through revolution, through the recognition that the system is extractive, that it cannot be reformed, that it serves creditors, not citizens. Step 7. System reset through destruction. Currency collapse, debt default, or both. The accumulated debt is eliminated, not through repayment, through destruction of value. Bondholders lose everything. Savers lose everything. The wealth built on 3 centuries of debt extraction evaporates, and the system resets violently. This isn't theory. This happened to France 1794. Assignats lost 99% of value. Happened to Weimar Germany 1923. Mark became worthless. Happened to Argentina, to Zimbabwe, to every debt system that reached stage 7. The mathematics are identical. The outcome is certain. In 2025, the United States is in stage 7. All 7 steps are active simultaneously. Interest consumes growth. New debt services old debt. The Fed is buyer of last resort. Inflation or default are the only mathematical outcomes. Credibility is eroding, evidenced by reserve diversification, gold purchases, BRICS alternatives. Political rupture is visible. Trust in institutions at all-time lows, partisan deadlock, inability to address the debt. The system reset approaches. The timeline from stage 7, entry to breakdown, averages 5 to 15 years in historical examples. The U.S. entered stage 7 around 2020, when pandemic spending pushed debt past sustainable levels and Fed money printing began in earnest. That means breakdown between 2025 and 2035, possibly sooner if a crisis accelerates the timeline. Look at the warning signs already present. Treasury yields spiking periodically despite Fed intervention. Foreign central banks dumping treasuries. Gold at record highs. BRICS nations building payment alternatives. Inflation persistent despite rate hikes. Deficits growing during expansion, not just recession. Political paralysis preventing any fiscal adjustment. Every indicator from previous stage 7 breakdowns is flashing red simultaneously. The machine built over 331 years. Permanent debt, money created as debt, interconnected default risk, central bank buyer, structural adjustment, consolidated bondholders, has accomplished its purpose. It extracted trillions from workers and transferred it to creditors. 1 trillion per year in just the United States, multiples of that globally. The largest wealth transfer in human history, sustained for decades, invisible to most participants. But stage 7 is terminal. The extraction that made bondholders wealthy contains the seeds of the system's destruction. Because debt compounds, interest compounds. The mathematics are exponential, and exponential growth in a finite system always ends the same way. In rupture, the 4 architects, Paterson, Rothschild, Morgan, Volcker, didn't conspire across centuries. They each solved a problem for their era's wealthy, but each solution built on the previous one. Each made the trap more sophisticated, more inescapable, and together they built a machine that could extract wealth continuously until the extraction destroyed the system itself. We are watching that destruction in real time. The $1 trillion per year flowing from taxpayers to bondholders will continue until it can't, until the mathematics break, until the currency collapses, or the debt defaults, or both. The pattern from every previous stage 7 breakdown is universal. The timing may vary, the specific trigger may differ, but the outcome is certain. The debt will not be repaid. It will be destroyed, and when it is, the wealth accumulated through 3 centuries of extraction will evaporate. The bondholders will learn what every creditor class in history eventually learns. Paper promises are worthless when the system that enforces them collapses. That is stage 7. That is where we are. And the mathematics say there is no stage 8. Only rupture, only reset, only the violent destruction of accumulated debt and the creditor wealth built upon it. The $1 trillion per year is still flowing. The machine still functions. The extraction continues, but the countdown has begun. And by the time the average person realizes the machine was designed to fail, the failure will already be underway. Unstoppable, irreversible, complete. This is not a warning. This is the pattern, and the pattern has never failed.